Greek banks have just days before they run out of money. Puerto Rico's leaders admit that the US territory's bust. China's government's resorting to desperate measures to try to shore up its plunging stock market, including buying some shares via government-controlled vehicles. On top of all of that, the world economy seems to be slowing again. Now, there are clear effects from each of these problems, with some Greek and Puerto Rican bond yields actually now higher than their price, which is quite extraordinary. And there's been a little bit of contagion to similar assets too. Commodities exposed to China are collapsing as well, along with the bear market. You can see this blue line here shows how the iron ore prices have been tumbling along with China's stocks, with copper in green coming down very, very sharply the past couple of days too. Commodity exporters are naturally hurt by the lower prices. One example is the Australian dollar, which I've put on here in red. You can see how closely that moves with iron ore, and it's been falling very sharply now at multi-year lows. Now, one might expect the obvious loss of faith in governments in both Greece and Puerto Rico, as well as the loss of faith, at least in the Chinese government's ability to elevate share prices, to have an effect by boosting demand for havens. Gold in particular is supposed to be a place to hide when difficulties erupt with government-issued fiat currencies, as they are in Greece, which is already split off from the rest of the Eurozone by capital controls. But gold isn't doing so well. It dropped $15 today to 1,155 an ounce. You can see that here, this red line. It's not far off the lows for the year set back in February, March. And silver's doing even worse, plunging today to make its own new low for the year. Even priced in euros, here the blue line, you can see that gold isn't looking like a great hiding place. The other two main haven assets historically have been the yen and the Swiss franc. The yen's done quite well over the past couple of weeks against the euro, but it remains weaker than it was in late May, and it's only a couple of % stronger against the dollar, which is really not that much of a performance compared with how it did during previous crises. The Swiss franc's done little even against the euro, so it's fallen along with a single currency against the greenback. Now, this lack of desire for havens in part reflects the lack of panic about Greece, China or commodities in the main markets, reflected in the only relatively small drops in German and US bond yields, as problems have intensified over the past 3 weeks. Consider, after all, that US shares are down only 3.3% from their peak, really not that dramatic. Now, perhaps Greece will be contained, in spite of the slapstick approach of Greece negotiators meeting in Brussels today, where they seem to have presented the same proposal that was rejected at the weekend. China might well be contained too, even if its botched market interventions contradict its supposed plan to move away from central planning. Puerto Rico is legally messy, but there is still hope there for a negotiated solution. Meanwhile, cheaper commodities are generally good news for the big developed economies which are consumers, even if at the same time they're very bad for the likes of Australia, Canada and many emerging markets where they dig the stuff out of the ground. Still, the haven assets themselves look pretty unappealing. Remember that gold has lost a lot of its allure with a drop of 40% over 4 years, while the central banks of Japan and Switzerland are going all in on Zimbabwean-style money printing. Those who think that Greece, Puerto Rico, China and commodities aren't just a series of isolated problems may need to be rather more creative in finding somewhere to hide from the impending disaster.